Hi everyone, my name is Vendik and you are welcome to the channel. So we are going to take an intensive class, all right, on market on price action. So we are going to cover almost everything from price action, starting from market structure, liquidity. We'll talk about institutional candle, entry types. We talked about imbalance, premium, and discounts. I believe these are actually the basic things you will really need to know when it has to do with price action. Okay, so because of most of my students, all right, that are still in class currently, so I will use this medium to explain this thing, all right, so that you get to understand how it is. Okay, so let's start from market structure. Okay, all right, when we want to talk about forex trading, okay, and then price action as a pattern of trading, market structure is something you can overlook. Okay, something you cannot overlook because it is actually the structure of the market that actually introduces you to the price and what the market is going to do. So we'll take most of the examples, all right, of what market structure is. After that, we will explain in details on how it looks on a real market. Okay, so let's say that we have an impulsive move upward. Okay, we have something like this. We have another one. We have a retracement, and we have another one. Okay. Um, okay, this is a serious. Okay, this is a market structure that. Okay, so this is what you will be looking at. Okay, we have a bullish market. Have a bullish market where we are going to call this a high, and we call this a low. All right, so we have a higher high, and we have a higher low. We have another, we can have another higher high. We have another higher high. We have a higher low. Have a higher high. We have a higher low. Have a higher high. Okay, so this is what makes a bullish trend. All right, so if you have a higher high and a higher low, have another higher high and higher low, okay, it simply means the market is uptrend. Okay, the trend is up, right? We have an uptrend. So there are some situations if you have a lower low and a lower high, another lower low, a lower high, okay, a lower low, a lower high, a lower low. Okay, in this market condition, it is called a bearish trend. Okay, this is a bearish trend. Okay, we have a bearish trend. Okay, you have a lower, you have a lower low, and then you have a lower high. All right, you have a lower high. So continuously having a lower low and a lower high gives you a downward momentum. So this is how market is formed. This is how the structure of market is formed. Okay, so with this you can know the basics of how market is formed. Okay, so market creates a higher high and a higher low, a higher high and a higher low if it is moving upward, and then if it is moving downward, it creates a lower high, a lower low, and a lower high. Okay, so that is basically how market is formed. All right, so okay, let's take another example and then explain this in details. Okay, we use this as a symbol to represent the overall market. Okay, but this is not actually how it looks like when we are looking at it on a real market. So in a real market, you will have something like, okay, you have something like a lower low. Okay, let me put a serious impulsive move. Okay, all right. Okay, let's say something like this. Okay, in a real market, we are looking at something like this in a real market. So what you need to know is that when a market moves up, okay, towards the retracement form, it's not just going to come down very straight like this. Okay, so in a smaller time frame, you have something like this. You have something like this. In a smaller time frame, you have something like this before the overall movement. All right, the same thing happens here. You have during any form of retracement, okay, market chubby around, did a whole lot of things. Okay, so you tend to see this before the market moves. So this is how it normally looks like on a real market. Okay, so market don't just go straight. All right, so if you are looking at the bearish momentum, it's just an invert. Okay, you invert this particular stuff that I just explained. Okay, if you invert it, it becomes the bearish of it. Okay, so that's basically how market looks like on a structure. Okay, let's try and look at it on a real market scenario. Okay, a real market scenario, because I explained something. I said when market is doing, okay, I explained something and I said when market is forming a lower high and a lower low. Okay, when market is forming a lower high and a lower low, it doesn't just go straight. So there's some sort of a confusion that happens if you are just using your eye to look at it. Okay, so the more you practice, okay, the more you get to know how these things really works. Okay, the more you practice, the more you get to know how it really works. So let's take this particular zone. For example, let's take this particular zone, for example. All right, let me zoom in. Okay, so we were saying if market is bearish, okay, if we were saying that if market is bearish, we will be having a sort of a lower high, a lower low. But if you look at this in a real market, okay, it's nothing similar to what I draw. Okay, it's not even close. Okay, it will not even look like what I draw. But if you are looking at it, okay, I can still draw that particular stuff on this chart. So we break structure here, we had a little retracement, we break structure. Okay, we have another tiny retracement, we break structure again, we have retracement, we break structure, we have retracement. Okay, we did not break structure. Okay, so anyone that you did not break structure is considered invalid. So this particular point was not valid. Okay, so this was what this particular one was valid. Okay, and then the retracement was very small, and then we had another one here. Okay, so if I should take my drawing off the original price, okay, so this is exactly what you are looking at. Let me change the color. Let me change the color so that you will see what I'm trying to say. This is a lower low, this is a lower high, this is a lower low, this is a lower high. Okay, we form another lower low, a lower high, a lower low, a lower high. Okay, we form a lower low, a little retracement, and then from here we are looking out of a reversal. Okay, so this is what it looks like in a real market. Okay, it doesn't really look like that particular structure that I was drawing. Very clean. Okay, very clean upward movement. So it doesn't really look like this. So you'll be looking at something like this one. Okay, so this is what market always do. So okay, for you to be profitable, all right, so you really need to study retracement area. All right, you really need to study retracement area. This will really help you to understand how market structure works. Okay, just study the retracement area. Okay, study the momentum area. Okay, where you have more impulsive move, okay, tend to be your retracement area. Okay, like all these big institutional candles, All right. I know that if you're a beginner, that will sound so strange to you, but this is how it is. Okay, so we have a downward move, a retracement, a downward move, a retracement. We now do change of character. We did not hold, we retrace. So ability for you to understand price action, okay, per time, okay, will really help you to stay away from some certain trades that will hit your stop loss. Market structure moves in two ways. It moves up and it retraces. So what you should study more now is how to get yourself into the retracement zone so that you can continue the trend. Okay, so before the end of this series, you will understand more when we get to imbalance and entry types. Okay, so I believe with this explanation you should be able to know how market moves. So another thing is that market moves in a range. Okay, so if we're having impulsive move, okay, let's assume we were trading upward. Okay, let's assume we are trading upward. Okay, so this particular move, right, let's assume we're trading upward. This okay, this will be our swing low, and then we will have another one, a swing high. Okay, at this point, this is the swing high we have. Okay, so this is our retracement zone, and this is the high of that particular swing. All right, so if market break this point, and then create another high, another swing high, okay, and then we wait till after the retracement, and if it creates another swing high, so this become our trading range. Okay, so if this one breaks, if this other retracement breaks this previous swing high and form another swing high, okay, so our swing low will move to this point. And this become our trading range. Okay, so each time market does this, okay, your trading range change. So that's another thing you really need to look at when you are looking at market structure, because what trading range means, it's at your trading range you have your discount level and then your premium level, okay, where you get to the market. So when you are on your range, you will need to find where to get into the market on your trading range. Okay, so this is basically how market is formed. So if you look at it on a real market, okay, let's assume this was our movement. Okay, let me take this particular point as an example. Okay, so let's say this is our market on a real time. This is our market. We have impulsive move upward, we have a retracement zone, another impulsive move upward, we have a retracement zone, we have another impulsive move, we have a retracement, okay, and then so on. So this is in a real market. So what you do is that this is your swing low, okay, and this is your swing high. This is your swing low and this is your swing high. Okay, and this become your trading range. Okay, you understand, this become your trading range. So immediately the market broke this particular structure, okay, and create another swing high. Okay, your swing low move to the previous swing low, okay, to the new swing low, sorry. Your swing low will move to the new swing low, and this will become your trading range. So what happens is that you will start looking at your discount, okay, from this particular range you are trading. So you look at where you can get into the market when the market is retracing, so that you can join the trade. So that is how market structure is smooth. Okay, in the next episode we'll be talking about liquidity. Okay, I will try as much as possible to document the whole of this series so that anybody that wants to go into trading and it chooses price action can just go through this series and then understand the next move, okay, of his career. Thank you very much and see you in the next episode. Hi everyone, my name is Vendik and you are welcome to the channel. So we are still in our series and today we will be talking about imbalance. Okay, so I'll try as much as possible to make this video very fast. If you find value, okay, in this, you can just support the channel by just subscribing, turn on your notification. Okay, it's just a YouTube business, all right. So at least that's just one of the things you can just do to support us. Okay, you might subconsciously forget to do the YouTube business. It's very important. This really help us to know that you are finding value in what we are doing here. Okay, so without further ado, let's get to the chart so that we explain this in details. All right, when I'm talking about imbalance, okay, it's just very simple. All right, it's a moment in the market where market tends to move fast, okay, fast, and then drop inefficiency. Okay, I know this is a whole lot of English. Okay, inefficiency, especially for the people that are just beginners. Okay, so market tends to move very fast and drop inefficiency. So with this diagram on your screen now, I will explain everything, okay, so that you understand it properly. So if time will permit us, we can go back to a normal chart so that you see, I can mark it out for you. Okay, so this is what imbalance is. So if you can check it very well, all right, okay, market tends to move, all right, from here to this point. Okay, so the previous candle that opened, all right, this week, the week of this particular candle is supposed to balance up with the previous week before this body. Okay, so that is how market does. Okay, that is the original part. Okay, how market supposed to move, right? I don't know if you understand me. The normal way market supposed to move is that every imbalance, every inefficiency is supposed to be covered up with time. So there are some situations whereby market tends to move faster and then it drop a gap and keep drop inefficiency. Okay, there's a space that it has not filled up. I think that particular word really explains it. Okay, give a space without filling it up. Okay, so when there is an imbalance like this, okay, in the next 3 4 5 6 candles, you will tend to see market coming back, okay, to fill up that space. All right, so market don't always move. It doesn't always like to move and leave those imbalance, those inefficiencies. Okay, so market would tend to come back and retest that zone. All right, and retest that zone. Okay, so I believe this diagram really explains what I'm saying. Like for example, after this, okay, we have 1 2 3. If you look at it very well, there is also an imbalance in this particular candle. Okay, but after the one that creates that imbalance, the second one, okay, the second candle, which is this white candle, it came with a wick and fill up that imbalance. If you check it out, you see it fill it up. Okay, so it balance up this particular candle. So that's what market always does. So if you see, we are going down. Okay, the next candle opened and then it become it move very fast, drop inefficiency. The next candle that opens, fill it up. Let me take this as an example. Okay, if actually market, okay, let's accept that this is the inefficiency, this is the imbalance that we have here. The market drops down, okay, it gets to a support zone or a liquidity zone, and then it rebounds from a certain zone. Okay, come back. Why it's coming back here is because of this movement that happens here. Okay, it needs to come and fill it up. It needs to come and rebalance. Okay, you need to come and rebalance this particular move that it creates. Okay, and drop this inefficiency. Okay, so the market needs to come back and fill it up. So that's when we always call another word, call it a fair value gap. So a gap. Okay, So they call it an imbalance, they call it a fair value gap. Okay, they both of them are the same thing. It's just different people looking at it in different perspectives. So it's just a gap that the market drop in between the market. So it always come back to fill up that gap. It's as simple as that. Okay, so there is no too much big explanation on it. Okay, so just know that if market moves so aggressively and drop a space between a candle, that there is higher tendency that the market is coming back to rebalance it. So that's just exactly what imbalance is. So this could have been so immediately you see this kind of rejection from a particular zone coming to that imbalance, you should be expecting a reversal, all right, from that particular imbalance, around that particular imbalance, and then you can decide to sell back, and then that is just it. Okay, so it's as simple as that. I think let's get to the chart so that let me look for a way and see if I can get an example of something like that. Okay, so I think this is one. Okay, sorry, let me remove all my drawings. Sorry about that. Okay, so I think let me use charts. Okay, this was an imbalance. Okay, and this was very thick. Sorry. All right, so this was an imbalance. Okay, if you check from where I draw from here to this point, okay, market moves here so aggressively that these two candles, okay, let me zoom it very well so that you can see. This is what I mean. The distance between this place where this previous candle stopped and where the next one also stops. Okay, as you can see, so there is a space here, there's an imbalance here. So this particular point here is the balance, is the imbalance that the market creates. So when you have something like this, okay, and the market moves so aggressively upward, okay, you should know that at some certain point, if you are uptrend, okay, you will soon have a rebound, okay, a pullback to that inefficiency. Okay, you have a pullback to that imbalance or a fair value gap or whatsoever you want to call it. Okay, but just know that when there is always a gap like this in the market will tend to come and fill it up. Okay, so the order that he left here without picking, okay, he came back to pick up those orders. Okay, there are orders that were dropping here, that were here, so he needs to come back and pick those orders and then move. Okay, so that's just what it means. So even if I don't know if he's coming to pick an order, but this is the nature, the pattern that market always move. So something like this, it's a great move if you know your bias was correct. Okay, the bias for the day was correct. You are uptrend this 15 minutes. So as you see something like this, look for a form of a buy option around this place. Look for a form of a buy option around this place. And this could have been a very clean trade. So there are little concepts like this that is not complicated, that you're supposed to be trading off of. Okay, it won't cost you anything. All right, you keep it as simple as it can be. Okay, so if you notice that you are uptrend for the day, okay, and then you find a fair value gap or an imbalance like this, is an opportunity for you to look at that zone very well. Wait for a market to come to that zone and find a form of your entry. Okay, the entry I traded yesterday, now look for an entry in that zone. Okay, when you get a confirmation of your entry there, it's a good opportunity for you to buy. Okay, so it doesn't mean if you are failing, all right, it won't work 100%. That's another thing you really need to know. As you're coming to the industry, all your strategies are not going to work 100%. It will fail most of the time. Okay, if you fail, if you enter 10 positions and then you have 6 positions as a win position, if your risk to reward ratio was good, you are definitely a good trader. You are good with that. You can live off that. Okay, 60% is more than enough. All right, so don't try and look for a strategy that will give you 100%. Okay, just look for something that will give you an average and something you can trade with. Okay, so that's it. So it doesn't mean it won't fail. Okay, it doesn't gonna be very sweet the way I just explained it. It's not really gonna work like that. Okay, there are some fair value gap that will fail. Okay, some fair value gap that we feel, definitely there are some that won't hold. There are some movement that will happen and there is no fair value gap. There are some fair value gaps that market will not come back and retest. Okay, but these things are things that we've studied, people have studied for some times and noticed, okay, this is what it always does, and then they put it all together. All right, so please don't combine fair value gap and indicator. Just don't mess up your chart. Okay, what if you are trading trend line, just trade trend line. If you are trading support and resistance, just trade it. If you are doing price action with a good entry technique and exit technique, fine. Okay, just work with what you have and stick with it. What gives you confidence for you to trade your real money? It's not the strategy, it's not the market, it's the consistency. It's the consistency you have when you were back testing. Okay, you see the risk to reward ratio. Okay, then this gives you confidence that you can lose 1, 2, 3, okay, on a row, and you'll still be fine with it. Okay. Okay, so these are things that makes a trader, not because you are winning your trade all the time. Anybody that is telling you that you are going to win your trade all the time, 100%, that person is not telling you the truth. Okay, so if there is anything about imbalance, this is exactly what it is. Okay, so go, as after watching this video, go back test this within yourself. Okay, just back test everything I just tell you now. Go find those imbalance. It's very easy to see it. You can spot it anywhere, anytime. All right, so this is exactly what I mean. Okay, this is where this candle just moved drastically. This was the last candle. Okay, you see market tends to reverse, come back, and then initiate himself into that particular zone before going up again. So it's as simple as that. Okay, so just try and make sure you keep your trading rules very simple and then stick to them. Backtest them with the rules. This will give you a percentage that you can work with. All right, so I think the next thing we'll be talking about is the premium and discount. So I think I'll drop the video tomorrow. Okay, so these are little concepts that you really need to put into place. Okay, after premium and discount, you will start looking at more advanced stuff, for at least for a beginner, and things that will keep you in profit. Okay, so you can trade only off of this and be profitable. That's what most of your mentors will not tell you. Okay, there is no magic, there is no style of system that someone that you are paying for class will tell you that is not already out. Okay, so if there is any mentor you are paying for, he should teach you application. He shouldn't teach you forex. Okay, it should teach you what is applying, what is working for him. Okay, so let him teach you application. He shouldn't come and tell you what's the definition of forex and candlesticks. Okay, he should teach you application, right? So I believe this really explained this. If you have any question, you can drop it on the comment section. I will be there always to answer all your questions. Please don't forget to do the YouTube business. This will really help us, okay, to keep posting. All right, share the video, subscribe, like, give a comment, all right, so that the video can reach out to other persons. All right, I think I'll call it a wrap here. See you in the next episode. Thank you. On price action series, we will be treating institutional candle today. Okay, so don't forget to do the YouTube business as we journey on. All right, let's get to the chart so that we'll explain this. Okay, when we are talking about institutional candle, it mustn't be a candle. All right, this is what you have to put in mind. Okay, that institutional candle, it mustn't be a candle. Okay, let's take for instance, we have a kind of a consulting area, something like this. Okay, let's say for example we have something like this. Okay, where market bounce off of a reject multiple times. Okay, multiple times, and let's say the overall trend of the market is down. Okay, then the situation, you will see something like this. You see something like this. A kind of a candle breaking above those highs, and then later comes back. Okay, there's something like this. Okay, this kind of situation, all right, if you check, the market just kind of bounce off here, bounce off here, bounce off here,
bounce off here. Okay, it mustn't be like 4 or 5, it can be 2, it can be double top. All right, and then you see a sudden candle will break above those support level, and then it tends to reverse back to the range and start falling. Okay, so the whole of this move, okay, is considered as institutional candle, right? It can be a candle, it can be a move. All right, why I said it can be a move is because if you go to a lower time frame, if it is a candle in 1 hour, if you go to 5 minutes, it's not going to be a candle, it's going to be a sort of a collective candle moving in one direction. So an institutional candle, it can be a move. It's not necessary for it to be a candle. Okay, so let's take for instance, I think I made some drawing that will really help. Okay, let's take this for example. All right, so let's say market bounce off of here, like bounce off of here, market bounce off of here, bounce off of here. Okay, bounce off of this point. Okay, that's 2. Before it bounced twice like this, retail traders tend to get into the market at this point. Okay, let's say get into the market for a sell at this point, because the market is coming back. Maybe put their stop loss above, okay, the previous swing high or something. They just find a liquidity that they can put their stop loss off of. Okay, so this is what institutions do. All right, when they come, all right, they first of all buy the market above the initial entering position. Okay, they buy it above initial entering position, and then the market will tend to wipe every other person's stop loss, right, before the market sells off, before their position is triggered. And then where they always sell off, okay, it's always at the round figure. There will be no fractions in those numbers. This is another thing you need to put into consideration. Okay, if you are buying at 1.30, okay, if it is, this is where they are buying, okay, they won't buy at 1.30879. No, they will buy it at something that is round figure. Okay, something like this. They'll buy it at something that is round figure. Okay, something like 1.30800. Okay, there will be no fractions in those numbers, so they tend to buy it at a whole number. Okay, so you always need to be looking at this so that you know where your entry is going to be. So if we want to reverse this, so if market was bouncing off all these levels and then you kind of have a push up, it doesn't mean market has reversed. Okay, depending on the area you are and the trend of the market. So it doesn't mean it can just be an institution coming in to take over the market. So you really need to be aware of this each time you are in a trade. And then probably if your stop loss, if you are someone like me that always keep 30 to 40 pip stop loss, okay, to give a trade a room. All right, it kind of gives me more confidence, okay, while I'm trading. You can just bring all the 7 pips and 10 pips SL. Okay, so it's something like that. So it all depends on you, but this is the definition of institutional candle. So when you are doing a price action trading, you should be expecting something like this. Okay, a whole lot of persons give you the name like the takeout, liquidity sweep, all right, liquidity like the manipulation. Okay, there are a whole lot of names, a whole lot of persons are giving it, but it tends to just be the way markets react. Okay, all right. So because one thing, if you know the basics of trading, is that if you want to buy things in bulk, you need to go and see where sellers are. Okay, so a bearish move, okay, for an uptrend, you first of all see a bearish move, okay, below the previous support level. First of all, see a bearish move below previous support, and then this will tend to happen around the round figure. So you need to study this more by yourself, right, and then be able to enter the market off of that. Okay, this will really help you. Okay, so in price action, you will always see something like this. when it has to do with price action trading, you will see a whole lot of manipulation in the market. And this is, they call it manipulation. So I just see it as persons coming in with bulk of money, looking for more liquidity to grab so that they can sell off the market. So everybody needs to be smart, all right, so that at the end of the day they will be able to go with something. So it's that also. So you really need to put this into consideration, and then you define every of your entry. Let it be that you are grabbing from a liquidity, okay, so that you can join the trend. So I believe this really explains institutional candle for you, because you will hear the name and it will look so funny and it might cause a confusion in your head. So this is just what it is. So if you want to check it for, okay, let's check the example on a real chart. Okay, so let's pick up something that can really works out. Okay, this is typical example of it. I think that one, the previous one didn't really define it because there was a whole lot of wick on it. So this is it. Okay, let's take this as an example. All right, market bounce of this place. Okay, I think we have first, second, and third here. Okay, so this particular move, if you check it very well, all right, if you check it very well, it tends to reverse around the whole number, all right, it tends to reverse around the whole number or the fraction. So these are things you really need to put in place. Market is already, it's selling, it's gonna sell. Okay, but all the people that enter, because after this first pullback, okay, a whole lot of persons are going to place their sell order here. A whole lot of persons are going to place their sell order here with a stop loss a little bit, maybe above here or something. Okay, they target the next previous high. Okay, this was the previous move, so they will target it, okay, as their next support. Okay, maybe the market didn't get to there, another set of persons entered the same thing, and they were expecting the market to sell off of this zone, because if you didn't see this play out, you will not know. Okay, this was a very nice bearish move. This was a very nice bearish move. This was a very nice bearish move with a correction into a fair value gap, very clean. Okay, so we are expecting a sell off of it, which the market finally did. But do you look at this place? Just look at this particular point. There is a whole lot of manipulation around here. Okay, after this first rejection, maybe you get into this candle, you, even if you calculate it, the whole pips, the pitch of this will be very much. Look at almost 300. So no one pips their pitch up to that level. Okay, but you see the manipulation that happens here. Let me remove this and zoom it so that you see. So you see a whole lot of manipulation happening here. The market breaks off of this. Okay, if you calculate this move, it's a more of almost 155 point move. Okay, that move alone, if you were all these breakout traders, okay, you feel, okay, market has changed direction, you now enter for a buy. Okay, that's not it. Okay, the overall trend of the market was bearish, so this kind of breakout might just be an institution that comes into the market. Okay, so the people that were doing breakout after the first impulsive move, they'll get in for a buy, and then the market reversing, it hits their stop loss, and the people that were putting a sell on this particular place, their stop loss too will still be hit. Okay, so they have advantage on how they manipulate the market. So I believe this alone should be able to explain institutional candle. So you have to be cautious, put this into consideration before entering to any trade. Okay, so if you find value in this video, don't forget to do the YouTube business. Just share it so that every other person can get the information. Okay, welcome back again. My name is Randy, and we will continue from our last series, okay, on price action class. Today we want to treat liquidity. Okay, so we will take so many examples, and then what is liquidity. All right, so without further ado, we'll get started. Okay, so liquidity, it's an area in the market where we have some sort of orders being placed. Okay, so we have so many types of liquidity. We have double ice. Okay, swing high and swing low. Okay, we have double highs, okay, and then double lows. We have daily high, we have weekly high, we have monthly high and lows. Okay, so there are a whole lot of stuff. So I will show you how this is in chart. Okay, so I try as much as possible to make sure that this tutorial is just the screen and my voice you will see, so that you won't get distracted by any other thing. All right, so in this part of series today we'll be talking about liquidity, okay, and how to spot them in the market. So it's actually everywhere. Okay, so what is going to make you different from another trader is ability to know the one that is going to hold. All right, and this tends to be out of a whole lot of practice and being on the chart. Okay, it's not that all your life you're going to be in chart, no, but at least for the start you're actually going to give much hours of your day to the chart, so that at least you get to know one or two things. Because when it has to do with trading, okay, what other mentorship classes, what you will not hear from mentors is that they will tend to tell you that there is one special thing they will tell you that will make you to be profitable. It's all a lie. It doesn't work that way. Okay, it's when you spend time with the chart you get to realize, okay, what really works and what does not really work. But most of this concept it was created out of intensive study of this particular chart, and they tend to give it some name. So you just need to follow it up, okay, and then have a starting point. Okay, all these are just to give you a starting point. Every successful trader has one particular thing he's doing that is always giving him money at the end of the day. Okay, so their chart is not always rumble and the rest of so many indicators. All right, so as you can see, this is just my chart, and it doesn't go more than this. Right, today being Tuesday, and we are on a 15 minutes time frame. So if you just go down a little bit, you see a whole lot of liquidity sitting almost everywhere. Okay, so let's start from okay, I think on this chart I've already marked up my swing high and swing low. Okay, let me go a little bit deeper so that the chart may have a whole lot of concrete information that we can work with. Okay, so this is a GBP USD. All right, so seeing this alone, this is what I'm anticipating on GU. Okay, a buy, but with a whole lot of a sell stop, a sell order. Okay, so you just really need to be very, very sure. So I believe this place now, I have liquidity sitting here. Okay, today I was expecting a card news to give me an impulsive move, but it tends to give me something very, very small, not really. But actually we are still running on, I think, 40 in profit, but that doesn't matter. Okay, what matters is liquidity to us as it stands now. So we have like roughly 4 types of liquidity or so. Okay, we have equal lows, equal highs. Okay, swing highs, swing lows. We have daily, weekly, and monthly liquidity pool. Okay, so let's take this as equal highs. Okay, let's take this as equal highs. So if market creates equal highs, okay, you tend to get a liquidity in the next pullback, right? And then you sell off from there. This is what I mean. You were going up, you had a retracement. The next retracement did not break this other structure, did not break this. Don't know if you can see. The next retracement did not break this. It gets here and reverse. You remember in market structure, okay, for you to have a continuous uptrend or a continuous downtrend, market after retracement, it must always break the previous high, okay, for you to form another new range. Okay, so if you not watch that video, I think you should go back so that you can document everything. But in liquidity pool, okay, we tend to create equal highs. Okay, equal highs means trade bouncing off a particular point, okay, more than once. Okay, it gets there, reverse, create a high wave, had a retracement. Okay, create a high here, had a retracement. So the next pullback supposed to be above the previous high. Okay, okay, to create a new range, but the market fails. As it fails, it came back, all right, create a normal lower low, trying to create a new higher high, but it fails too, creating another lower low, trying to create another lower high, it fails. Okay, then before a pullback, and then we had a change of character. So as I always do, if I give example, all right, I'll always pull it out, my drawing out. So this is what I mean. So if we want to say equal highs on liquidity, so at a certain zone, market creates something like this. Market creates something like this. So automatically there is immediately these two times a market bounce off here two times. The next time coming, okay, you know that it's just coming to pick the remaining order that was there. Okay, just coming back to pick the remaining order that was there. So you really need to put this in mind, right? So this is liquidity and how liquidity works. Okay, so with that being said, we want to treat another one. Okay, so for example, immediately you get a change of character. Okay, I think we would treat that as the series is going. All right, immediately you have a change of character and you have impulsive move. Okay, that was the opportunity for you to sell. The market has already confirmed that it's reversing. So these are things you really need to put in place. So that's on equal lows and equal highs. So another thing we want to talk about is swing high and swing low. Okay, so at a particular time frame that you are, okay, market always tends to create equal highs, swing high and swing low of that particular line. Okay, let's say we are in 5 minutes and this is today's chart. Okay, this is today's chart. Yesterday we came back and clear yesterday liquidity. Okay, remember? All right, market always drops the liquidity, so we came back yesterday to clear yesterday liquidity. So immediately we clear, we now started moving forward, upward. But remember, this is a reverse point. We did not yet confirm the trend until this particular level is being broken. Until this particular level is broken. So now we confirm that we are up. Immediately this point was broken. Okay, I get in, but that was too risky though. I get in, but I could have waited for this to confirm. The second one could have waited for this to confirm. Okay, so but we chubby around for some time before we now break upward. So that's it. So this creates equal lows for me. All right, remember the first one I show you are equal highs, but this creates equal lows for me, and I have a change of character on that particular time frame. Okay, the 5 minutes that I was looking at for my entry, I have a quick change of character and I get into the highest retracement I was expecting was this. Okay, I think that's 40 pips itself. So that was the highest retracement I was expecting from here. And I think for like 1 week we are almost just dancing around here and we are trying to reverse. So anything below this, I will be out of the market and I'll collect the loss. So that's how to identify equal highs and equal lows. So the next thing we want to talk about is swing high and swing low. Don't worry, we can use this GU and then explain all these things because we always find it on the trade all the time. So equal highs and swing high and swing low. If you see, it's always something that is always on my chart. Okay, because this helps me to have a trading range. Okay, so currently, remember on market structure, we talk about when market breaks a particular previous high, you create another low, you create a new trading range. You remember that? So this was a market structure. Okay, we break this previous one. Okay, it breaks this one. Let me take something and indicate so that you see. It breaks this. At this point, we create a new high, and a new high to here was our new trading range. So we had a retracement, we bounce off of it, and then we create a new trading range. Okay, so on the new trading range, we had another impulsive move here. We break above the previous swing high here. Okay, we create another sort of new trading range. Okay, we create another trading range. Okay, so that's why I mark up this swing high and this next swing low. Right, that's how I mark up this swing high and swing low. So this become our new trading range. So we retrace in, all right, to our a discount rate. Okay, I know in the course of the trade we'll get to know difference between premium and discount in trading. So currently on this we are on a discount region, so we're supposed to have impulsive move, and mind you, this is trading. Okay, the market is always right. Okay, we might decide to break. So if we break below this swing high, it simply means market has reversed. But we since overall trend of the market is upward, okay, so we are anticipating to create a new high above this swing high, okay, so that we can form a new trading range. Okay, so that's how it is. So this is how equal swing high and swing low is created. So I think this really explain a liquidity pool for you. Okay, so I think in our next episode we will be discussing about institutional candle, right? So liquidity is always established at the level where stop orders are resting. Okay, where stop orders are resting, that's where liquidity always. That's where we can find liquidity. Right, so liquidity is formed where stop orders are being placed in the market. That's where stop orders are established. So we have buy side and sell side liquidity. All right, and please put all this into consideration. All right, so that you won't fall into a liquidity trap. All right, you know, most of the traders, they will tend to keep a buy stop, okay, because they have this bounce back. Sometimes market can decide to go above the swing high, okay, pull back inside the range, okay, and start creating change of character, and then the market will move back. So because the range is created, okay, the swing high is created, doesn't mean that really broke off of that the market is doing. You know, even if it broke out of it, you need to really wait for confirmation that you are uptrend before you get into the market. Okay, so we don't react like that. If you react like that, 5 times out of 15 trades, you will always be stopped up. Okay, so please put this into consideration. I know there are a whole lot of persons that are doing is it breakout strategy, all those breakout strategy, everything. All right, so be very very sure and practice more so that we get. But this is all about basics about liquidity. You know, ICT will come up with a whole lot of things because they are trading 5 minutes. Okay, smart money concept. They are trading 5 minutes, so they do come and find liquidity in every 5 minute range. Okay, it does hold normally. It will hold. Okay, so this was a liquidity. All right, this was a liquidity. But if you are checking it from 1 hour, it's almost the same thing. But this gives you more details. All right, so if you check it out 5 minutes or 15 minutes, immediately you see you broke out of this. This is what triggered my trade, and then I was confirmed after the reversal twice from this area. I was confirmed that I'm going to be bullish, and I get it. So already I think I was trading at 40 pips. So I really trying to hold this trade for a very long time, maybe probably a week, right? Probably a week, and then I'll see what I'll get out of it. There's no guarantee on the trade yet, okay? Because all these are still liquidities. You might decide to bounce off of or any of them, depending on what the market is doing. So I was waiting for CPI today, but I didn't really get anything out of it. So for now, we'll still keep the trade running. Okay, so I think this is all you need to know about liquidity. So tomorrow I'll try and explain institutional candle, and then we get into entry types, imbalance, and premium and discounts. Okay, so it's just one after the other. So if you're just starting trading, okay, you can just follow the course one after the other. Okay, and if you are following us live, like as we are dropping it, I think is the best thing you just need to do. Okay, just follow it up one after the other. At the end of the day, you will realize that you almost know everything about price action. Okay, so if you found this video interesting, okay, don't forget to do the YouTube business. Drop a like and share so that every other person can get the information. Okay. See you in another episode. Hi everyone, my name is Vendik and you are welcome back to the channel. So we are still in this series. Okay, so today we'll be discussing premium and discount. I don't want you to go and see this online and then get yourself confused. So okay, don't forget to do the YouTube business. Subscribe to the channel, give a like, and then you can ask whatever your question is on the comment section. Okay, I will attend to you. So without further ado, let's jump into the as it is. Okay, premium and discount. If you want to buy something on a regular market, okay, you would tend to buy it when there is a discount, or you buy it when the market falls. Okay, if you want to buy a TV, okay, a LG product, you wait when the company is doing a promo or they are running a discount on their sales. Okay, you buy it then. Okay, that's the you look for, or you wait for the demand of the product to reduce so that the price can go down so that you can buy it. Okay, so it's the exact same thing. Okay, you apply to financial market. Okay, so if you want to buy, you wait and buy at a discount zone. All right, and then if you want to sell, all right, you sell at a premium zone. Okay, you wait for the possible highest price you can get, and then you sell. If you want to buy, you buy from a discount zone. If you want to sell, you wait for you sell at a premium zone. You wait for the highest price possible to sell from. Okay, to sell your market. Okay, so it's the exact same thing in real life. You apply it to market itself. So there are some little concepts you can attach yourself with it, and it will really help you to know how you can mark up a discount, okay, and a premium zone. Okay, so without further ado, okay, this video is supposed not to be that long. I'll just open a chart and then we'll look at it. Okay, so let's say this is a range, okay, that the market has moved. Okay, let's say market moved from here to this point. Okay, that is what breaks the previous higher high. All right, this is what breaks the previous higher high. So this is the range, and we are in a pullback zone. So in this pullback zone, you will look for where to buy the market from. So if you should use something, okay, even if you want to use square and divide this into two, the movement into two. Okay, all right, so if you want to use this and divide it into two, the whole movement, you just highlight the movement. Okay, this is what you should be looking at. You see, I in my rectangle, I make some division. I divide it into two. Okay, there's a white dotted line in the middle. Okay, that's what I use in identifying half of it. Okay, half of the zone. So if you want to buy, okay, this was the first impulsive move. If you want to buy in this market condition, you wait to buy at a discount zone, not at a premium zone. Do you understand? So what will be the discount zone? If discount zone is after 50% of the move, so anything down here, it's a discount zone for you. I think I should use drawing, not charts. I should use drawing, not chart. So if we have market coming from a higher high, I should use drawing, not chart. And then we have something like this. Okay. Okay, so this let's say this is the move. Okay, this is the move from here to here. Okay, from here to here is the impulsive move. Okay, so now the market is trying to make an corrective move. The market is trying to make a corrective move, which is where we're supposed to enter a buy from. You understand? So now if you measured from the impulsive move always have if you divide it into two, the upper side is the premium and the lower side is the discount. So if you are to buy, you buy at a discount zone. If you are to sell, you sell from a premium zone. Okay, I know if you turn it upside down, it's still going to be a discount zone, but there is a premium, there is a discount. So a premium equilibrium is the 50% of it. So if you are to buy from a discount, you need to wait for the market to pull back below the 50%, which is the equilibrium state. So just wait for the market to pull into the discount zone. So if you have any form of entry models in this what do they call discount zone, is a good idea, provided you are in line with the trend. It's a good opportunity for you to buy from there. Okay, so it's a good opportunity for you to buy from there till you get above the previous swing high. Do you understand? So that's just the difference between a premium and a discount. You can decide to label this. Okay, so let's label this. Okay, so this is how it is. So this is it per diagram. So this is a discount and this is a premium. Okay, so it's as simple as that. So if you get below the 50 equilibrium state, okay, you tend to see a discount. Okay, so this downside is the discount and the up is the premium. So if you are buying, always buy from a discount zone to a premium zone. Okay, if you are selling, it's just the same thing but opposite. So that's the difference. That's the difference between a premium and discount, and that is how we use it in the market. So it's as simple as that. Okay, so I try not to show myself on this series. I think this will be the end of it. After we'll fall back to our normal regular YouTube videos. For anybody that wants to come into the market and try price action as a trading strategy, I believe with this video you have everything you need. Okay, and we even added some additional things, okay, so that you won't get confused if you come across these particular words online. So it's as simple as that. Remember, in market structure we say something like market, okay, that if you are to buy from aftermarket structure, you should be looking at buying from corrective mode. So normally you have to buy from here when it comes back here. So if you apply discounts and premium, it's still going to fall in between there. So you look for a zone to buy from. Okay, so if you have a reaction that shows that, okay, you have to buy, you buy. If you don't have that reaction, you allow it. Okay, you don't force market to do what. So but when someone is saying discount and premium, this is exactly what it means. Okay, it's not something complicated. Okay, you are just to buy from where the market is giving you opportunity and the price is cheap. You are just buying cheap and you sell high. So that's premium and discount. That's just it. So don't buy market at a premium zone. Okay, if you buy it at a premium zone, market can decide to still dip down to where you have a discount. We have some others at discount. You will pick it from there. So be very, very conscious of this, and then you will not have any problem. Just keep it simple. And then I think this is where we'll wrap up this series. Okay, we'll fall back to our normal YouTube videos. Okay, and then if anybody wants to check price action, you can just come into this. I think I simplify everything as I can. Okay, so just follow it step by step. You will understand everything that has to do with the price action. Okay, so if you complete this course, if you are in this course till now, it simply means you can analyze chart by yourself and then predict the market, and it will be in your favor. So it's as simple as that. So I think this will be the end of this series. Okay, so see you back, or catch you back on the channel. Okay, so if you've not done the YouTube business, please, it's the only way you can assist us. Don't forget to share and then subscribe. Okay, give a like. You can comment. If you have any question, you ask it on the comment section. I will respond to you. Okay, so let's call it a wrap here. Hi everyone, my name is Vendik and you're welcome back to the channel. Okay, so still on the series, today we'll be treating entry types. Okay, you can call it an entry model. So okay, let's get to it without wasting much of our time. All right, so I'll just get straight to the analysis. That's why I made most of these drawings so that the video will not be that long. Okay, so that you get it this trade. So we talk over entry models. Okay, so based on how I enter trade personally, okay, there's the one I call the risk entry, and there's the one I call a justified entry, okay, or confirmed entry. What's the difference between these two? There's an entry that you are sure of the trend, okay, then you just get in at the order block, or um, you get in at the order block, or you get in at a fair value gap. Okay, just place your order and the market tends to bounce back from there. All right, there's another one that you are not sure of the movement, you are not sure of the trend. Okay, you are sure of the trend, but you want to confirm that your trend is right. Okay, so I call it a justified entry. Okay, or you can call it a confirmed entry. So those are the two types of entry we are looking at that I personally use, and it works most of the time. So because this really help you on your prediction after knowing the bias, the structure of the market, you know the bias of the day, and then you get this confirmation, okay, or you just get in based on the assurance of the trend. Okay, these are actually how I get into the market, and it gives me perfect entry. Okay, so number one, I call it a risk entry. Because why I call it risk entry? Because you've not yet confirmed that the market is reversing from there. Okay, so you just enter it because you are sure of the order block. Remember what I told you on previous video, that you can't assume in the market. So that assumption makes me to call the risk entry. Okay, so I will explain that in detail, but before that, let's just take an example. Okay, I'll use this drawing to explain it. Okay, so you are sure of the trend. Let's assume you are sure of the trend that you are moving down. Okay, you are sure of your trend, and then you have your previous lower high, and the market is bouncing back to your previous lower high, where you are very sure of your reversal. Okay, so you just get in here. Okay, let's say you just get in on the trade here without knowing if the trade is going to reverse from there or not. Maybe just probably keep your stop loss above the trend. Okay, this is a kind of entry I call a very risk entry, because you've not yet confirmed the direction of the market. Okay, you've not confirmed the direction of the market, so that's why this one is a risk entry. Okay, you are just sure of the trend. Okay, and then you get in at your order block, or you get in at your previous liquidity. All right, we've tripped liquidity on this series, so you know what that means. Okay, so let's assume, okay, you just get into your nearest liquidity, and you are sure of it. You just get into the market and put your stop above the previous high, and then the market just came in and then right in your favor. Okay, so this is one. Okay, I don't always recommend this pattern, because if you are trading a lower time frame, you may easily get stopped out on this particular confirmation. So it is a very nice entry that if it goes in your favor, you tend to get a higher risk to reward ratio. Okay, so that's it. That's just the advantage of it, but you've not yet confirmed the movement of the market, okay, before getting into it. So the next one I want to is a confirmed or justified entry. Okay, is a confirmed or justified entry. Okay, so let's assume that this is the kind of pattern you'll be seeing. Remember what I told you, that trading, okay, is not always what I draw. Okay, and in a real market, it won't always look very clean like this. Okay, there's gonna be a whole lot of manipulation, checking, a whole lot of wicks, okay, that you really need to study by yourself. But this is the pattern you should be looking at. Okay, so let's assume we take this as an example of justified entry. Okay, so we are very sure of our trend, all right, that we are going downward. Okay, we are moving down. Okay, we are very sure of our trend that we are moving down. Okay, so let's assume this is your previous lower high. Okay, and then you are looking at to sell from this particular liquidity here, or probably gap, order block, whatsoever you want to call it. Okay, let's say you are selling from here. So this is what makes it what do they call it, okay, a justified entry. This is what makes it a justified entry, that you wait for market to get to that zone, all right? You allow the market to get to that zone. You understand? You allow the market to get to that zone. When the market gets to this particular zone, you look at for change of character because the market has reversed. So this particular movement that breaks this previous low here means that the market is about to reverse. And then as the market is going back up, all right, maybe a reverse from a fair value gap or an order block. Okay, so this tends to be a justified entry because you are sure that there is a weakness in the movement. Okay, market is showing some sign that is losing momentum, so we are actually going the opposite side of where we are going. The first one was risk because you were not sure as the market gets to this zone if it's going to break above it, all right, or it will respect your order. But this one, you are sure that market respect this order, and then there is a break of structure, there's a change of character, there's a change of character here, and then you are having another confirmation maybe from an order block or fair value gap that you are going down. Okay, so that becomes your perfect entry. Let's assume you were trading, you were following your trend based on a 4-hour time frame. So for you to look at this justified entry, okay, to be sure of the trend, you need to go like 2 steps down. Okay, if we are using 1 hour, you should be looking at your entry. Okay, you should be looking at this change of character, all right, from a 5 minutes or 15-minute time frame. Okay, so those are the things you really need to put into consideration. So how to do this? You can go and watch a top-down analysis, how top-down analysis is being done on the channel. That will give you more clarity on how to step down on a particular chart you are. Okay, so to get a justified entry, you won't stay. If you are trading at 1 hour, if you're trading 4 hours, if you are trading daily, you need to step down before this entry will reveal himself. If not, it's still one candle you will see, and you might not be very sure of the reversal. Okay, so top-down analysis will really help you in this, for you to know the direction of the market at a particular time frame. Okay, so another thing I want to add to this, okay, because I didn't want this video because the explanation is supposed to take longer. So there's another thing. Okay, this is typical example. So if you wanted to enter a trend, this is the difference. Okay, let's assume you were downward and then you are coming to a bigger order block. Okay, let's say you were on uptrend. Okay, and this is your order block from your higher time frame. Let's assume this is your order block from an higher time frame. This particular big one I'm drawing. Okay, let me bring down the volume a little bit. Okay, I believe you can still see it. Okay, so let's assume this box. All right, let me change it so that it should be very short. Because okay, let me change the color to red and increase it a little. Okay, let's assume this big bar, it was an order block or a fair value gap from your bigger time frame. Okay, so this is what you should be looking at a lower time frame. Okay, if you are trading 4 hours, okay, you step down to a lower time frame. So this is what you'll be looking at. Okay, so when market gets to your order block, let's assume this is okay, this order block here, let's assume this is it on a lower time frame. So market will come inside the order block. All right, normally if you enter from maybe 50% of the order block and then you start to buy, okay, it's risky because you've not yet confirmed if the market is weak at that zone, if it's going to respect, all right, if it is going to respect that entry, because you can get into it and you have a whole lot of momentum in the market break through that particular order block, and then instead of him to start still going up, you now have a change of character that the market is reversing from that zone. I don't know whether you understand. So this is what will really help you. So I prefer justify entry. You wait for the market to get to your order block, all right, then you start seeing a change of character. Okay, you start seeing a change of character. What's a change of character? This is a change of character. instead of us to create a higher low, we now start creating a higher high. Okay, so we all understand, because I know I've explained this on market structure very well. Okay, so the trend of the market. So at once you stop having a lower low, okay, and you start having a lower high, it simply means there is a shift in the market. Okay, so there's a momentum shift. So go and look at your market structure video very well so that you understand. So instead of us to have a higher low, we now have a higher high. This simply means there's a weakness, okay, in the market. So if you enter from here, if you enter from this zone, okay, this was supposed to be our risk entry. Okay, let me draw something so that you know. If you enter from here, is a risk entry. So after you confirmed this after you've confirmed this change of character, all right, after you confirm this change of character, if you enter here, it's a justified entry. Okay, if you enter from here, it's a justified entry, and this is another change of character here. Okay, this is another change of character. Sorry about that. This is another change of character. All right, so if as the market is coming back, all right, this is another perfect entry for you to enter. So in this kind of entry, you are very, very sure that the market is reversing, because there's almost a two change of character confirming that the market is really weak. Okay, so there's going to be a reversal. So this is how to get a justified entry, okay, from a risk entry. So I believe this really explains. I don't know if we should go to the chart and then you should look for example, but let me just look at a live chart, okay, maybe on gold or on whatsoever. Okay, let's say okay, fine, let's take this place as an example. I know the trend is not that much. Okay, let's say we are going down. Okay, this is the current market structure. Okay, so we have a lower low, a lower high, a lower low. Okay, and we are very sure that we are to create another, right, we have to create another lower high from here, because of let's say we are trading off of this particular fair value gap. Okay, so if you just get into the trade like this, if you just place an order here, okay, if you just place an order here, all right, to sell from here to this particular zone, maybe keep your stop above this point, all right, it's a good entry, but this is a risk entry because you are not sure of the trade that is going to reverse from here. Okay, it's going to reverse from this zone. Okay, you are not really sure, you just get into it, but based on your confirmation and that you are going downward, this was a very nice entry. So this is how to get a justified entry. Okay, so let's say from this box, this is 5 minutes, let's go to 1 minute. Let's go to 1 minute. Sorry, because I just used that 15 minutes. Okay, let's go to a 1 minute. All right, so this is the 1 minute. The market was doing a higher high, a higher low, a higher high, a higher low, higher high, a higher low. So the next one that's supposed to be an higher high failed to be an higher high. We now create a lower low and failed to create another higher high. Okay, so this particular move alone shows that there is a weakness. Okay, the market will respect there's a weakness on the market, on your zone. That this alone shows that your prediction is right. So the only thing you need to wait for is a change of character. All right, so this change of character will really give you assurance that okay, you were right on your prediction. So you wait for market to break below the previous lower low. Okay, so as the market breaks below the previous lower low, is a confirmation that you are going down. So from there you can wait for maybe a retest. Okay, this one didn't actually retest because immediately it breaks, it was just a one straight move. Okay, very down, was immediately it breaks the structure, and immediately you have a change of character, right? Immediately you have a change of character. This was where you rebound. Okay, so you get here, you failed to do a higher high. It simply means you've confirmed. So this will be your entry, confirming that you are down. All right. So this will be your entry, and your stop loss will be below the swing high. Okay. So this is what happened. So I remember I told you before that if you enter on risk entry, the only advantage you have is that you have a higher risk to reward ratio. But if you enter based on a justification, okay, entry, you will lose some percentage of your risk to reward ratio. So if you measure it with ruler, you will see that before you get there, it's already 30 pips. So you lost 30 pips, and you are sure of the trend. And if you enter off of risk entry, you could have added 30 more pips to your entry. So that's just the difference between the two of them. So this is typical example, so that the video will not be very long. So practice this, back test this within yourself, and be very, very sure you get confidence on entry. Okay, so if you have done your market structure, you've done liquidity, you've done institutional candle, and then you are currently done with your entry currently, you should be able at least to predict market. Okay, while we'll be adding more advanced stuff on the series. Okay, so but with these four videos we've made already, you can predict your market based on price action and then be accurate. Okay, so you've gotten your market structure, you've gotten your liquidity, you know what is liquidity, you know what is institutional candle, and now you know how to enter into the market. You know your entry types, your entry models, you know how to enter into the market. So with these 4 videos, you should be able to predict the movement of the market, place a trade, and it will be in your favor. All right, so start back testing this on previous data. All right, so that the video will not be long. So just back test this with your previous data, like go down to 2014, 2015 on TradingView, back test it, and you will see this thing works every time. Okay, it doesn't matter what you are trading. Okay, so other things will be added to this series. Some things like maybe I'll do a separate change of character, and then break of structure on this same series. I will add imbalance, I will add premium and discount range in the market. Okay, so let's just make sure you do the YouTube business. Okay, right? Subscribe, share to other persons to see it, and give a like. Okay, just comment. This will really help us to grow and then provide you with more valuable content like this. Okay, see you in the next episode, and peace out.